Jeffrey Gundlach, he had said not too long ago about the Federal Reserve that the Fed predicted totally different policy than where they are now. How can they predict 2020 policy with a straight face? The aforementioned Jeffrey Gundlach with us now. Jeffrey, good to have you.
Hey, Neil, it's good to be with you.
So you're not a fan, certainly, of the Fed's predictive abilities, but what if it moves to hint of a move, I guess, that's the consensus, of a cut in rates next month? What do you think?
Well, I think they're not going to cut rates today. I do think they're going to change their rhetoric again and talk about a lack of progress on inflation, which is kind of funny because when I was a kid, progress on inflation meant you were getting it down. Now progress on inflation is getting it higher. So it's kind of weird, but the Fed needs to change its rhetoric to get in line with what the markets are saying. Some people say that the Fed's being harangued by the president, but it's really being harangued by the bond market. I mean, the bond market has been saying that the Fed's policy is too tight by a very large amount for the past several weeks, if not few months.
Do you think that?
And the Fed simply cannot ignore that. They need to give some respect to what the bond market is talking about. So they will talk about failure to make progress on inflation, and they'll probably talk about the reason that their past forecasts weren't so great was because the tariffs have gotten to be more of a problem than they anticipated. So that's the way they're going to find cover for talking about a future rate cut, probably in the not too distant future. They might even set the table for July, but certainly September.
A lot of people say it would be a mistake to cut in this environment because there's no reason to cut. Leaving that aside, you still, before any of this dust up, we're talking about a 40 to 50% chance of a recession in 6 months. Why? Why do you see that?
Well, we at DoubleLine have developed an awful lot of indicators that give us a little bit of a forward look on whether the economy might be weakening. And for about 18 months ago, they were all super strong. There was no sign of any economic weakness whatsoever. But one by one, it's not a clean sweep by any means right now, but one by one, certain indicators have started to weaken. In particular, the consumer confidence in the present is very high, but the consumer confidence in the future is very poor. And usually that relationship, when it gets to how it's looking right now, starts to sense a recession coming within 6 to 12 months. Similarly, the most important indicator that the New York Fed also uses as its recession model is the shape of the U.S. Treasury yield curve. And people have been talking about this appropriately for a long time. But the 3-month bill yield compared to the 10-year Treasury yield has every bit the look of a recession coming within 12 months and maybe within 6 months because that rate is inverted. What would really kind of put the icing on the cake for that would actually be the Fed easing, ironically. A lot of people think if the Fed eases, it'll be an insurance policy against recession. But if past patterns are prologue, if we actually start steepening out the yield curve from an inversion 3 months to 10 years, that's actually a highly coincidental with the coming recession. So there's a number of things that are deteriorating. Also, economic data. Citibank has a index of compares current data releases to their 12-month moving average. And all over the world, those are steeply in negative territory and have been all year and in the Eurozone even for the last full year, not just year to date. So there's plenty of indicators the recession might be coming. Also, consumer spending, I believe, is at risk because of the tariff fears. I mean, we've already put significant tariffs on some Chinese goods. If we end up putting tariffs on more Chinese goods and do that coincident with the president rhetorically talking about, well, we're going to make a deal to remove the tariffs, that will absolutely put a halt to imports from China. Because if you were going to buy something from China with a 25% tariff on it, and you suddenly started to get rhetoric that the tariffs might go away in, say, 3 or 4 months, you're going to stop that buying decision. So maybe the president is really as diabolically clever as some of his conspiracy theorists like to say, and maybe he's actually trying to get the economy weak now so that consumer spending can rebound very sharply in 2020, just in time for the presidential election.
Who knows?
But that puts,
let me ask you about that. And you mentioned the president, Jeffrey. He had tweeted out the other day that if he's not reelected, the market's going to crash. What do you think of that?
Well, I think that I don't know about crash. I mean, he's always fond of hyperbole. But one thing that really is interesting is a lot of the current polls that have come out. I know it's very, very early for 2020 presidential polls, But a lot of candidates in the Democratic field are polling substantially stronger than the president is right now. And at some point, I think, if those polls start to become more believable, the market is going to have to start pricing in the fact that the corporate tax cut that buoyed the stock market, obviously, would go away. I mean, many of the Democratic candidates are vilifying corporate America, and obviously, as part of that vilification, eliminating the tax cut would be a prime policy idea. So I think the stock market would drop if there was more confidence in a Democratic candidate winning, because the tax plan would be reversed.
At this point, but do you think the president will get reelected?
It depends on the economy. I'm not even sure he's going to really run. I mean, if the economy goes into recession and he can't pull it out by removing the tariffs, there's very little for him to run on. But if the economy is strong, the president
started it yesterday. So you think in that case he might pull out?
Well, Lyndon Johnson ran for a while too,
Very good
and then
point.
pulled out because of the war problems. I mean, things can change.
Yeah.
But I mean, the base case, if the economy does not slip, the president will win re-election. And I think the fact that the market is hovering near its highs, in spite of the fact that these Democrats are polling, some of them 10 points higher in some of the polls than President Trump, suggests that the market simply doesn't believe these polls, at least at this juncture.
You've been worried about our debt more than anything else, and you've been worried about this bubble that we ignore and all of that. Knowing that you saw the housing crisis coming well before the meltdown, do you see anything like that happening again?
I think the next recession won't be a thing like the housing crisis. I think it'll be a corporate debt problem and an interest rate manipulation solution. Because I think, given the fact that last year, 2018, the national debt grew by over 6% of GDP, while nominal GDP grew by 5.0%, I mean, it suggests that the entire economic growth of 2018, in essence, was an increase in the national debt, that it was debt-based. So in the next recession, you would probably see an enormous increase in the national debt, perhaps as high as 10% of GDP, which would, under natural market forces, lead to higher long-term interest rates, exacerbating the recession. So what might end up happening is the Federal Reserve might have to come in and emulate the ECB and the BOJ and start pegging interest rates down at a level that's low enough that we don't have this compounding problem with the debt. I see that as being kind of fundamental as the problem in the next recession. Also, corporate debt
or they would just start
is very high versus GDP.
They would start buying everything up in sight, like the quantitative easing that the president lamented.
Yeah, that's what I mean. I mean, that's what manipulation is, yeah.
All right, and you're afraid that would happen again.
Ways.
You're afraid that would happen again.
I think that this concept of modern monetary theory, that you need interest rates lower than economic growth, is already in the mindset of our central bankers. Look what's happening in Europe. They're talking about going more negative. They need even more negative interest rates. And yet we have a system of corporate finance where there's many fragile companies that should be gone, but they're being kept going as zombie companies because of the interest rate situation that we're in. And so Jim Grant writes a great letter, and I got mine in the mail yesterday, and he talked about how weird it is that low and negative interest rates in Europe are causing zombie companies to go on, and they don't want the zombie companies to disappear, so they need even lower interest rates. But it's the negative interest rates that have caused the fragility. So they're in a circular logic where the negative interest rates are causing fragility, but they think the solution is even more negative interest rates. And this is going to be a very big issue in the next downturn. So yes, I was very concerned about the housing market back in late 2006, but I'm much more worried today about the corporate bond market than I am about things like housing in the financial system.
Especially those corporations with not pristine debt, right? They're exposed to this, right?
Well, take a look at Deutsche Bank. I mean, Deutsche Bank is down 95% from 2009. It's down something like 65% in the last 3 years. And the stock is trading at around 7. So I guess it has strong support, 7 points lower. But the situation with the negative interest rates makes it impossible for them to really get out of this. situation of endless price declines. And so we have a systemic risk in the European banking system, and it's emblematic. Deutsche Bank is emblematic of that fragility.
You know, Jeff, I talk to a lot of people who heard, and they obviously respect and follow you closely, as do I, when you come out with something like the 40 to 50% chance of recession, or say that we're in a bear market, when technically we don't have the 20% drop, but you follow these other things that telegraph that we are. They point out the fact that cash levels are at their highest in a decade, so there's enough concern or caution or cynicism out there not for the markets to run away with themselves, that it's not like the giddy 1999-2000 period. There's a lot more sober reality there. What do you make of that?
Well, there's always massive amounts of cash on the sidelines. The last refuge of perma bulls is, oh, there's all this cash waiting to pounce into the market. There was a lot of cash on the sidelines in 2002, and there's a lot of cash on the sidelines in 2007. So I don't think people hold cash waiting to go into a rising stock market. I think they hold cash for a variety of other reasons. So I've never found that to be a convincing argument. And by the way, the stock market is in a bear market. It dropped over 20% in the fourth quarter. The New York Stock Exchange Composite is well off its highs, and the global stock market is so far from its peak that it's really an anomaly that the United States is hovering near its highs.
Let me ask you a little bit about politics again and Joe Biden. Now, he is the Democratic frontrunner right now. He is the one who leads in all these states against the president. That could change, but you did note that his flip-flops and playing to conservatives, playing to liberals. Do you think he will end up being the nominee?
No, I don't. I think Joe Biden is kind of like, a placeholder type of candidate. Joe Biden's been running for president for 32 years. And in those 32 years, he ran 2 official campaigns, and he did a couple of trial balloons, and he chose not to run. But in those 32 years, he's amassed exactly 0 delegates. So it's almost hilarious that he's called this electable candidate, because he dropped out in 1998 on a scandal, and then he made it to Iowa in 2008 and got less than 1% of the vote. I think Joe, his time has passed. I have a nickname for him, Jurassic Joe. It's not a reference to his age. It's a reference to the fact that he's a politician from a different era. And the progressive movement left in the party, I think, is going to be problematic. I've been reading recently that the mainstream of the party, the old establishment, is now starting to warm up a little bit more to a little bit left-leaning, but not so socialist candidate like Elizabeth Warren. I think she has a better chance than Joe Biden. I also think Buttigieg has a reasonable chance, too.
Interesting. You're referring to his first run. That is Joe Biden's 1988 run, when he was charged with copying speeches.
Yeah, 88.
Let me get your final sense, then, of where the whole market is right now. You know, this president pays a great deal of attention to it. It's oftentimes conflated with the economy. If you're right on this market and that it's going to head into something worse, that can't be good for the economy. So whoever wins in 2020, they've got a mess on their hands.
Yes. If the market does drop, it would probably be quite consistent with that recession coming before the election. And when the next recession comes, there's going to be a really big problem, as I said earlier, with the national debt. And they're going to have to go into some sort of extraordinary situation of basically money printing, I think, to combat the next recession. Universal basic income, which some Democrats are already running on. I think that sort of thing has to become a reality in the next recession. So you're absolutely right. In the next recession, the people in power across the developed world are going to have a lot of difficulty on their hands. And so, unfortunately, that's the consequence of a debt-based economic system that we've had in place for over 35 years.
Yeah, you're at the mercy of it. Finally, a personal question. I've long respected your smarts and coming from nowhere to be the billionaire investor you are, but you like the Buffalo Bills. And I know there's loyalty to the home, but it's the Buffalo Bills. Could you explain that?
Look, I grew up in Buffalo, and in Buffalo in the wintertime, once you go into December, there's really nothing to do other than watch the Bills or go bowling, back in the bowling craze when I was a kid. Okay. So I'm a big Bills fan, and I think actually the Bills are on the right track for once. I don't have
I hear that every year.
excessive
I hear
optimism.
it every year.
No, not for me.
Okay,
not for me.
Right,
not for
right,
me.
right.
Not for me. They finally got rid of their ridiculous dead cap situation. Last season, they had $53 million in dead cap. So they were playing with $53 million less than other teams. That's all gone. So go Bills.
All right. We'll bet some chicken wings on that. Jeffrey Gundlach, very good seeing you. All right. You got it. You got it.